gentlemen, welcome back to the People's Law School. As I said, this is a production by the Alabama Trial Lawyers, the Alabama Association for Justice, to bring to you the best lawyers in America. Mike Wisner, our next speaker, is a tax lawyer, and he's going to talk to us about a topic that is near and dear to all of us. He's going to talk to us about how to deal with the IRS. When he originally gave the topic, I put it down as fighting the IRS, and he said, "Alan, don't do that. It's not fighting the IRS. I get along with them just fine." And he says, "I have a lot of friends over there, and that's not what we do." But what I would tell you is that if you have a lawyer like Mike Wisner representing you, you will get the best results. And anybody that deals with the IRS in any type of serious matter better have a lawyer, or you better have a CPA. Don't call those people yourself all by yourself without having an intermediary. I've learned that in my 40 years of practicing law, and I will tell you, Mike Wisner knows what he's doing in this regard. He, by the way, grew up right here in Huntsville, graduated from Huntsville High, went on to Alabama, and he graduated from there, and then went to Cumberland Law School, where he graduated cum laude, and on to New York University, where he and his Irene not only watched him get a tax degree, an LLM they called it back then, but they had a great time enjoying the sights and sounds of New York City. He says it's one of the best years of their life. Thereafter, they had 4 children, and now they have 2 grandchildren. And Mike, as I said, is one of the tax lawyers that I will tell you in Huntsville, and I know all of them, that really does tax law. He has, for all these decades, really been a tax lawyer. What I have found is many get their tax degree and then they go on and do something else. Not Mike. He has spent decades in the area and knows what he's talking about, and it is my privilege tonight to present to you Mr. Mike Wisner.
Yeah, I asked Alan not to say that because I've had several revenue agents tell me that they've seen this on TV. And you know, I guess you can say we're fighting them, but they're really, you know, they're doing their job, and they've got some pretty strict rules about what they can and can't do. And if you understand those, they're a little easier to deal with. And believe it or not, there's a lot of them that are pretty nice and easy to deal with. Not all of them. Unfortunately, I don't deal with just the agents that are local here because I do know them, and I like every one of them. But you know, they're scattered all over the United States. And if you get a letter from the Memphis Service Center saying that they want to audit you or they got some problem with your return, and you dial the phone number, you may end up talking to somebody in Holtsville, New York, or out in Nevada, or over in Georgia. They just have this huge and robust phone system and huge and robust computer system. And of course, I'm not sure there's hundreds of thousands of employees, but there's at least probably hundreds, but at least scores and scores, tens and tens of thousands of employees. And just like any other organization of that size, you know, a lot of them are nice to deal with, some of them aren't so nice. They got bosses, they got to answer to people, and they got rules to follow. Now, I've given you all an outline, and I'll try to stick to a little bit because there's a kind of a natural progression in here. But people usually want to know right up front about exams, and the statistics that I have seen indicate that about any given year, about 1 in 100 people have some kind of exam activity with the IRS. And the reason I say some kind is because most exams with the IRS, or most inquiries with the IRS, they're almost not exams, they're inquiries, are handled by mail or by the phone. And they usually involve items such as math errors. These are the most common reasons you get audited. This is on the second page, my second page, it's under number 2. Math errors, just simple math errors, and they'll write you and tell you, we determined that there's a math error on here, and if you got a problem with it, please let us know. And if in fact the math was wrong that you sent in, then you accept it. You usually don't respond, you just write a check. Unallowable items, you take a deduction for something that you're not entitled to take a deduction for. And I'm sure y'all have seen in publications and maybe on the internet some of the crazy things people have taken deductions for, and they do get kind of wild. But most of the items that we're dealing with here They're not allowed, not because they're wild, but just because they don't fit your circumstances. Maybe your income level is wrong for the deduction or something like that. Also, matching information. You know, you get W-2s on your payroll checks, and you get 1099s if you're earning interest or dividends, and K-1s if you're involved in business ventures that have profits. And a lot of times these things are misreported, and of course the entity that you work for or the people that are giving you the 1099s or the K-1s, they're reporting to the IRS as well. So when you put it on the return wrong, their computer system is robust enough to say, hey, they don't match. And they'll kick out usually just a form letter the computer kicks out that comes to you and says, there's an error on your 1099, and a lot of times you can handle that without even talking to somebody. If you do talk to somebody, you know, it's just you either call them and acknowledge it or you ask them questions about it, and then if you determine you have made a mistake, you just send a check. Failure to sign returns. A lot of times they're sent back for something as simple as that. IRS has a form. They send it back. You didn't sign your return. Please sign the bottom here indicating you sent the return in. And then using the wrong forms. Usually if they're sent back for the wrong forms, it's because maybe you've got some, let's say, capital gain income and you reported wrong, or you might have some self-employment income that's been done wrong. And if you have a CPA doing your tax return, this almost never happens. And I say that because most of them have computer programs, and if you've been with them, you know they punch these things in, and they punch in the nature of the income and the nature of the deductions, and their computers just spit it out. I mean, it's incredible what kind of software the CPAs have now. And I say the CPAs because I don't prepare tax returns, and some tax lawyers do. Okay, so you've got correspondence exams, then you've got office exams or office audits, and that's where they'll invite you to come in and talk to them about your return, because there might be a number of items or there might just be some clarification they need, and you can go down to the IRS office and meet with the agent. Then we've got field exams, and field exams are a little more involved. They generally involve businesses or maybe high-income people. And in a field exam, the agent will come to you, and the reason they're coming to you is they want to be close to your records. If you're at their office and they ask you for something, you say, well, I didn't bring it with me. But if they're in your office and they ask you for something, you've got to produce it, or at least have a real good reason why it's not there. But they come to your office because they want you to have access to your records when you're substantiating deductions and so forth. Okay, this number 4 here under 2, this is an audit. It's not actually the name of an audit, but it's what happens in an audit when you're not cooperative and you don't give them what they've asked for, and they think you have substantially understated your income. And I call it an application of funds audit. That's what they used to call them. I'm not sure what they call them now, but I've always called them application of funds. And what they do there is they ask you for all of your bank records. And if you have several businesses, you may have multiple accounts. And if you don't give them to them, they can go to the banks with administrative subpoenas and get these bank records. And I mean, this is a true audit. They go through these bank records, and every deposit that is made in every single account you have is counted as income. Doesn't matter where it came from to start with. It's on the income side. Then the agent will do their best to determine, well, do we have any transfer from this account to this account? Because, of course, the second deposit wouldn't necessarily be income. They try to determine if you have tax-free income that's come in. They try to determine if you have any loan proceeds that have come in, any gifts, anything that shouldn't be taxed. And then they'll come up with a number. And what they're doing is they're making you participate. Because when you get the results of this application of funds audit, usually you got a higher income number than you were expecting. And a higher income number than perhaps you can prove. So it puts the burden on the taxpayer to sit down and do what they should have done to start with. I've got one right now that's going on. I got it, I think we were 2 years into the audit. I say we. The taxpayer was 2 years into the audit before they hired me. And the local agent had boxes and boxes and boxes of records. And ultimately, this is an unusual case, let me say that. Ultimately, the agent shut it down. The agent said, look, I've had this case, I think I was on it for 6 months. I've had this case 2.5 years. We've had a new boss come in from Nashville. He's cleaning this office up. I got to shut it off right now. So they shut it off before we were finished. And shut it off means we got a 90-day letter. I'll tell you what a 90-day letter here is in a minute. That means that I've got to file an appeal with the United States Tax Court in order to finish up showing what we should be able to take as deductions. Well, I'm here to tell you the United States Tax Court judge doesn't want to sit up there and have you handing him receipts for deductions. You know, they expect all this stuff has already been done at the IRS level. And they're there to make important decisions about the law. And so what the tax court does, and I've had this several times, and they're doing it now, is when it gets turned over to their lawyers, I say, look, I've still got some stuff I think I can show the agents, and we can maybe even get the whole case resolved by agreement. And so what they do is they kick it back to the appeals office. And this one did go back to the appeals office, and we were able to show basis in some real estate transactions. We were able to establish a theft loss, a large theft loss, $400-some odd thousand, and they accepted it. And we got one issue right now that still hung us up. We're probably going to get it resolved. I hope we're going to get it resolved. But if it gets resolved, we will have an agreement with the U.S. attorney that's handling this for the IRS, and we will submit a pleading to the tax court that says we're in agreement and this is the tax liability, and we won't have to go to court and waste the court's time. So application of funds audit is not fun, but if you're in the middle of one, it's your own fault. You've let it happen. Okay, so if you're going to represent somebody with the IRS, if somebody comes in my office and we need to call an agent right away, the agent will talk to me as long as the taxpayer's sitting there and gets on the phone and says, yes, it's me, and he's here helping me. But when the taxpayer walks out of the office, I can't write a letter or talk to an agent without a power of attorney on a Form 2848 being filled out. And that's the same for the CPAs and the same for the enrolled actuaries. There's 3 types of individuals that can help a taxpayer with a tax matter with the IRS, and that is an attorney, a CPA, or an enrolled agent. And enrolled agents are mostly retired taxpayers, but not necessarily. You can study to take the enrolled agent exam. If you take it and pass it, then the IRS will let you represent people. Okay, the audit process. Generally, if you're going to have an office or a field audit, not just one of these correspondent audits where they just say, hey, look, we found a math error or something like that, but they actually want you to produce some documents, then they will ask you to send in substantiating documents for any deductions you've taken. They may say you've got some income that you don't think's income. You got to argue that. You got to substantiate it. But they will look at that material. There's give and take. They'll listen to your arguments, but they come out with a report. When they first give it to you, it's a preliminary report. They just say, look, this is where we're coming from. You look at it, and if you don't agree with it, tell us why. And so you look at it, and you either don't have an argument that you can make, a viable argument that it's not right, or else you make your argument and they don't buy it one way or the other. And then they give a final report. And when they give a final report, you've got one shot to talk to their boss, and if the boss sticks to it with them, and generally the boss has already seen this report. You don't get too far with the boss very often when you go to their group manager. But the report becomes final, and you can appeal it. You got 30 days to file an appeal with the IRS Appeals Office in Birmingham. And even though the appellate officers are IRS agents and work for the IRS, they take a position sometimes where they don't agree with the examiner. I mean, if you come in and you've got the law or the facts, and you're arguing them saying, look, this was misapplied, or this statute either was ignored or else they didn't think it applied, and the appeals officers who tend to be better trained, or maybe they've been with the IRS longer, but they are, I don't want to say smarter. They're certainly not smarter people, but I think they have a broader base of training at the appeals office, and sometimes they go with you and sometimes they don't. If they don't go with you, then what you've got is a 90-day letter. I alluded to it a minute ago. That's where you get a letter, and it's called a 90-day letter because there's a statute that says you've got 90 days to file an appeal with the United States Tax Court if you're going to appeal this thing without paying the liability. Now you got another option. The other option is you can pay the taxes and sue for a refund with the IRS, and if they turn you down because they've already assessed it, they're probably going to turn you down. Not always, but probably. But if they do, you can go to the district court, federal district court. And sometimes there's a little forum shopping. I mean, I don't get into forum shopping, but some of these tax lawyers in the bigger cities that are in court all the time, they'll do a little forum shopping. And what I mean by that is the district court may have heard a tax case over here, and the judge feels a certain way about it, and you know that the tax court's been leaning the other way, so you do a little shopping about which court maybe for the issue that you're dealing with is going to be better to go to. But the downside of going to the federal court, district court, is you got to pay the entire amount of the liability. And honestly, most of the people that come to me, they can't afford to pay the full amount of the liability. You know, if it's worth going to court over. Now, there's a lot of IRS matters I help people with. You would never go to court with. You know, a few $1,000s, can't afford to send a lawyer to court, federal tax court or United States District Court for a few $1,000s. You just have to take your lumps. If you lose at the appeals level, then you just have to live with it. You always have to weigh the cost of litigation in any matter. Okay. Criminal tax issues. I'll just touch on this real briefly, and the reason I'm being brief about it is you simply see very, very little criminal IRS activity around here. I guess all the criminals live in the big city or something, because that's where, I mean, if you're reading about tax crimes, most of them occur in larger metropolitan areas. You know, I've been practicing law 35 years and 25 of them here in Huntsville, and I only know one individual that went to jail for a tax crime. And I helped him with the civil side of his liability. I got referred to him, and he was already in jail, and I went down and saw him in jail because they were coming after his assets. But that's the only one I know of personally in North Alabama. And I'm sure there's been a few others, but that's the only one I know about. All right, collections of income tax. Once the liability is had, one way or the other, either you reported it properly and just didn't pay it, or the IRS assessed it and you didn't fight it, or you lost your fight, whatever. One of the service centers will send you a letter, and they've got 4 letters they send you, and I've walked through them here, starting with collections income tax. The first letter is a real sweet letter. I mean, it says, "Dear taxpayer, we thought we would remind you that you owe us some tax. Please send us a check." And you know, you can ignore that letter if you want to. I mean, if you're going to pay it, you may as well pay it. But they're not going to do anything to you if you ignore that first letter, and a lot of people do. Matter of fact, most of the people who come to me to help them with collections, they've gotten the 4th letter. You know, they wait till they're about to have levy, or sometimes they wait until they've been levied on. Anyway, the second note comes about a month later, and it says, "Oh, by the way, we sent you a letter the other day. You're supposed to send us a check." You know, it's a little nicer. The third one uses the word levy in the title. It says, "We intend to levy on your assets." And you know, that's the one that really ought to get your attention. But the 4th one comes certified mail. And it says, "We are going to levy on your assets." And if you ignore that one for about 45 days, they will send a levy to the bank and have your bank account. They'll own your bank account. It'll be gone. They can send a garnishment to your employer and start garnishing your wages. If you have other people that owe you money and they know about it, then they can garnish that money. I mean, I've had doctors get their Medicaid and Medicare payments, and sometimes their insurance company payments garnished. In other words, they're supposed to get paid because all the health care insurance companies pay them, and Medicaid pays them, and Medicare pays them. IRS just sends a levy, and they got to send the money to them. And really, it's not, the tool is not there for the IRS to abuse you. It's there to get your attention, and that's usually when the IRS has the full attention of a doctor, is when they don't get their insurance checks and they don't get their Medicaid and Medicare checks. I assure you. And I'm not picking on doctors, but that's one that, I mean, I've got a lawyer I'm helping. He's I got a couple of lawyers I'm helping. But the one I was going to tell you about gets paid through Social Security, does Social Security disability. So all of his fees come from Social Security. So what does the IRS do? They levied Social Security. Easy. And speaking of Social Security, they can levy your Social Security. If you let it get to the levy stage, they have a right. Now, they have a limit on Social Security. They can only levy 15% of your Social Security, but they can take it. I've got one right now where I was talking with the taxpayer about working out an installment agreement. While we were talking, they levied on us Social Security, and we decided, well, we were going to probably have to pay them more than 15%. Now that they got you levied, they'll probably leave you alone, so we're just going to sit on it and see what happens. Because if they come in and try to garnish more, we can deal with it. That case is wild. This is a guy, I'll just tell you this, this guy, the liability that's being levied on that one, the Social Security, is 1989. And even the agents I've dealt with it on it go, where did this come from? 1989, think about that. 99, 2009, so it's 25 years old. And what happened, it's really an unusual situation, but the guy got into a tax shelter back in '89. He didn't know it was a tax shelter. Somebody came and said, "Hey, look, invest a bunch of money in our operation, and you'll save tons of taxes." And you know, when those tax shelters collapse, and you don't see them so much anymore, but when they collapse, you go like, "How could anybody fall for that?" But I'm telling you, these people that promoted them up front, they look slick. They look like they know what they're talking about. So anyway, he gets in this tax shelter. And he takes some deductions in '89, he takes some in '90, he takes some in '91, '92. Well, the tax shelter ended up being on the wrong end of a national audit. It was this guy was selling these things nationally, all over the United States, big time. So they went to tax court for the '89 year. And by the time they'd done that, he had taken carryovers for 90 and 91 and 92 and 93 and so forth. So they were after him for 89, 90, 91, 92, 93 taxes. But the only year that was in the tax court was the '89 year, because that was what it all was driven from. So all these years the IRS is after him, and I think the audit with the limited partnership went on for years and years, and it was in tax court. Anyway, so about 3 years ago, we determined, being me and a bankruptcy lawyer that I deal with all the time, we determined that he can probably discharge this liability in bankruptcy court. But we had been getting only correspondence for all the years other than '89. '89 was still in tax court. So we're getting notices from the IRS for 90, 91, 92, 93, 94. No notices for '89. So everything that we did for him was all these other years. We filed bankruptcy. All of his taxes were discharged. After the bankruptcy, they closed the tax court case and assessed for '89. They did this about 2 years ago. And I'm going like, you can't do that. Well, they can do it, because the statute remains open while there's a tax court case that's ongoing. And once it's closed, no matter what the other statutes say, the IRS has another 6 months to assess. And they assessed it. The bankruptcy lawyer opened the bankruptcy back up, tried to bring this in to get it discharged, and was not successful, because the other liability had been assessed 3 years, but this liability for '89 was only assessed 1.5 years, 2 years ago. So now he's on Social Security disability. They levied him, got 15%. We were going, and he's got, he's got income sources, or retirement income sources. And we decided, when the levy came, we decided, look, we just need to lay it low, because I think there's probably a 90% chance they'll take their 15% a year for the 10-year collection period. We'll get to that in a minute, but they got 10 years to collect. Whatever they can't collect in 10 years, they just don't collect. They're going to take 15% from him for 10 years, and he said, I can live with that, and then we'll be done with him. Very, very unusual set of facts, probably the most unusual set of facts I've ever dealt with the IRS. Anyway, okay, so collection alternatives. They're after you and they want you to pay. Well, most people that come to me can't pay. They don't have the money. And so you've got some alternatives. You can do an installment agreement, and generally speaking, they like to structure their installment agreements over 60 months. They like to assess what they can collect from you over 60 months, 5 years. So they have you fill out a Form 433A if you're a wage earner. If you got a business, you got to fill out a 433B. They're nothing but financial statements for you and your business. And they look at that financial statement and they assess your ability to pay. They've got a little, besides the assets and liabilities, the balance sheet side, on the income side, they got a little column that says this is your income, and then they got a little column over here and say these are my living expenses. If we're not doing the business one, we're just doing the personal. And they've got regional charts. For the Southeast United States, they got a chart that says what a four-person household ought to be paying for groceries, and what kind of housing costs you should have, what kind of utility costs you should have. And they will allow those numbers. They'll go down and add up their column. They add it up right next to your column. If they match and your expenses are exactly equal to or more than your income, they'll just deem you to be currently uncollectible. Usually what happens, though, is they'll come up with a little delta and say, okay, this according to this, you should be able to pay a couple $100s a month. And if you're okay with that, you can say, okay, I can live with that. Then you sign an installment agreement with them. And as long as you pay $200 a month for 60 months, they'll leave you alone. And then when that 60-month period's over, if there's still some residual liability, it just goes away. They don't collect it. Okay, another alternative is what's called an offer in compromise, which is basically a settlement. You know, I have people come up to me and say, oh, I hear you can, oh, you see it on TV. Pay 10 cents on a dollar. Well, you know, sometimes it works. It depends on your financial statement. It literally depends on that financial statement. You know, if somebody tells you before they've asked you anything about your finances, they can get you 10 cents on a dollar, they're lying. Because if they hadn't seen your financial statement, there's no way they could know that. Now, I've gotten to where I can look at somebody's statement and guesstimate, you know. It's a guesstimate because sometimes I'm wrong. I might say, yeah, they'll take $5,000, and they come back and say, no, we got to have $8,000. But at least you start a conversation when you make an offer in compromise, and they will come back and tell you, we can't do that, but we can do this. And then you got to decide whether you can live with it. Usually I tell them on these forms that the money's coming from friends or relatives. So if you're planning to make an $8,000 offer and you have on your tax or your financial statement that you've got $8,000 cash, they'll say, I mean, literally, I've always thought this was the stupidest thing in the world, but they'll say, give us $8,000 first and then tell us what you'll give us on an offer. And you're going like, so you got to tell them you're getting the money from a source. And if you say, I'm going to borrow it, they'll say, oh, you can borrow it? Well, go borrow it and pay us that and then tell us what you'll do on an offer. So, and sometimes they'll make you go to the bank and get turned down. You know, I've had people go down to the bank and say, the IRS says I got to come down here and borrow $20,000, but if you turn me down, they'll work with me. You know. And you know, as soon as you say IRS to the banker, I mean, you're not going to get your loan anyway. But you know, if you can get help from relatives or friends, that's generally speaking where the money. It's got to come from some source that the IRS couldn't access anyway. Yes, ma'am.
Aren't there penalties involved also?
There are penalties.
Late charges?
Yes, there's lots of penalties. Late payment's just one of the penalties. There's failure to file. There's understatement of income. There's overstatement of value. There's probably 30 penalties. Yes, there are penalties, and they run. And you know, frankly, if you don't pay your taxes for, you know, if you get behind, a lot of times people come in. I mean, they're not behind 1 year. They're behind 5 years. They haven't filed in 5 years, or they filed and hadn't paid. And of course, if you're a wage earner, it's almost impossible to do that. If that's all, if you're a wage earner, you're going to, unless you have fibbed on your withholding and told them that you got 12 dependents living at home when you don't have any, and that happens too. But you know, usually you've got to be somebody who's getting income from a source where there's not withholding, or else you can't hardly get in trouble. If you're just a straight wage earner, you can't hardly get in trouble. But yes, there's penalties and there's also interest. And you know, if you come in there and you're 5 or 6 years behind, I can just tell you right off the bat, usually you can just about double the tax liability with interest and penalties. Now, as you know, interest rates are down, and the IRS's interest rates are down. They go with the market, and they change it every month. I'm not sure what it is this month, but it's probably 3% or 3.5%. It's not a lot, but back in the years when we had a higher interest rate, of course, it was rougher. And obviously, the longer you go, the more it hurts. You know, I mentioned earlier you can go to tax court, not pay the liability and go to tax court, or you can pay the liability and go to federal district court. Well, one advantage there is if you pay and go to federal district court, you stop the interest and penalties from running. Whereas if you go to tax court, you're not paying the liability to go to court, and so the interest and penalties do continue to run. I had people tell me that they'll say, well, can't we settle this and just get them to waive the penalties? Well, you can make an offer in compromise, but you can't couch it in the terms of just waive the penalties and I'll pay the tax, the original tax. They just won't do it. You can give them that number and say that's what you want to do in an offer, but you can't say, oh, just waive the interest or waive the penalties. They just won't do it. Now, you can get penalties waived if you can demonstrate reasonable cause. You know, if you don't file on time and you get a failure to file penalty, well, if your house burned down a month before the taxes were due, and you can demonstrate that that's where my records were, then they will waive penalties under that circumstance. Sometimes people get bad advice from CPAs or non-CPAs that prepare returns, or maybe accountants that aren't CPAs. Sometimes lawyers get bad advice, and if it's reasonable to rely on the advice that you got, then you can get your penalties waived. Yes, sir.
What about bad advice from the IRS agents themselves?
Got to be in writing. They're not going to be bound by any verbal.
Even if you have it in writing?
If you have it in writing, absolutely. Yeah, if you got it in writing from the IRS. The question is, what about if you get bad advice from the IRS? And they have a rule that says if they give you written advice and it's wrong, then you can get your penalties waived. If it's verbal advice, they're not bound by it. And if you think about it, it makes sense because it's just a, you know, he said, she said deal. Yes, sir.
Two things. Could you mention the innocent spouse, and could you also mention taxpayer advocacy service with Nina Olson?
Okay. I can do that. They're later on in here, but I'll go ahead and mention them. Innocent spouse status, if you have liability, and this is usually when you have a business or something, there may be some liability associated with the business that one of the spouses didn't know anything about, didn't have any reason to know anything about. And if you can meet the innocent spouse rules, and they're not really that easy to meet, but you can, even though you filed a joint return, you can have the IRS determine you qualify, and if you qualify for an innocent spouse, you won't be held liable for the taxes. I've got this one I mentioned to you a minute ago that I'm in tax court on it, has an innocent spouse aspect to it going on. That's actually the one unresolved issue in the tax court in that one. You know, there's several things you got to do to prove innocent spouse. One is that I didn't know the income wasn't reported. Well, that one, you know, is probably pretty provable in a lot of cases. But part of the things you got to do is demonstrate that your lifestyle was inconsistent with the return. In other words, if you're living in a $600,000 house and you've been filing a joint return that shows you're making $60,000 a year, it's like, hey, you know, somebody. But, you know, in the real world, a lot of times a spouse, a non-working spouse, will sign a return, not even look at it. I'm not saying that's bad or good. Mine doesn't look at ours that much, but I mean, she doesn't. My wife doesn't. I mean, she signs it. I guess she looks at it a little bit, but my point is, if you sign it, you're deemed to know what's in it, and you know, it's a little bit disingenuous to argue, well, I know I signed my tax return, but I didn't look at it. I mean, but for innocent spouse purposes, if the income's inconsistent with the living style, you can flunk that. Now, as far as taxpayer advocate, if you're having a problem with an IRS agent at some level, I don't mean a problem like you have a personality dispute with them, but you don't think that they are handling something right or it's not timely. I think that's one of the big things. They're not getting back with you soon enough. You can go to the tax advocate office in Birmingham, and they will assist you. They really don't have any right to come in and make the agent do anything, but they get involved and the agent starts paying attention where maybe the agent wasn't paying attention to start with. And they get involved quickly. You can call them, you get a number with them immediately. My experience with them has been they are on top of it, and they are your advocate to be treated right. I think that's the best way to say it. To be treated right and for them to be responsive. But they don't come in and say, hey, you're wrong, you've handled this wrong, and I'm overriding you. They got no ability to override the agent on a matter. Yes, ma'am.
If your tax ID or Social Security is stolen and filed by a fraudulent individual, are you more likely to get audited?
It depends. I mean, if they file you talking about you file a return and they file a return?
Right. I filed last year, and it turned out somebody beat me to it and filed on my behalf.
Well, you file 2 tax returns under the same tax ID number, and yeah, there's going to be an audit. There's no doubt about that. Probably when they determine you're the right taxpayer, they're going to focus on whoever filed on your behalf. I've got one right now. I'm not involved in that part of it. I'm involved in some other aspects of it with a couple that just moved from Florida to Canada. But in the middle of their going through their audit process, they were from Central Florida, but somebody filed a tax return for the woman down in Miami.
Well, that's where mine got stolen from.
Yeah, yes.
In regards to that, there is an identity theft provision whereby once you've notified the IRS, they will give you a PIN number to attach to your tax form, and only that PIN number will be effective for filing your taxes. And then each year they will give you another PIN number, which will change each year.
Well, I have that, but my concern was on the year we found out that an additional tax return had been filed.
If you're concerned about future audit activity, I doubt it, especially if you've gotten a PIN number. The lady that got hers stolen that I'm dealing with actually got a refund because of she got the refund because of the other lady's filing. Well, the bad thing is she spent the money, and now they want it back. They're saying you shouldn't have taken that refund. So in addition to the other problems I'm dealing with that too. So okay. Offering compromise installment agreement. I mentioned earlier, if they deem you to be uncollectible, they'll suspend collection activities. Bankruptcy. If the tax has been assessed at least three years, you can bankrupt on it. A lot of people think you can't bankrupt on your taxes, but after 3 years, you can bankrupt on it. They got 10 years to collect it. If they don't collect all of it in 10 years, they can't collect it anymore. The tools they use to collect, I mentioned the levy. They can also file a tax lien. They file tax liens at the drop of a hat. I mean, they really file those quickly because they're trying to protect their interest in the equity in your assets. And once they file that tax lien, if you have real estate, you can't sell that real estate without dealing with that tax lien. Now, if you go to sell, let's say it's your residence, and you're selling it and not really making any money, and you can demonstrate to them that it's being sold for its fair market value and you're not making money, then they will release that lien and let you sell it. If you want to refinance it to get a lower rate, they will do that and allow that refinance as long as you're not taking money out. And they do that even if some of the money that's being borrowed is going into the loan cost. They'll let you gross up the loan a little bit by the loan cost, but they won't let you take the money out. They'll give a release for that. The bad thing about getting a lien release is it takes about 2 months, sometimes more. I'm working on one right now. I just got the letter back. It's been about 2 months. So, you know, if you're gonna have a sale of a piece of property and you're signing a contract to sell that property, you need to make sure you put in your contract that you'll have enough time to take care of that tax lien. Because, you know, closing contracts often say you got 30 days to close or 45 days, and that's a hard number. And or a hard date, and if you hit it and you haven't got that lien off the books, and the buyer decides they want to bail on you, they can bail on you because you've failed to meet your part of the contract. So if you have that problem and you're having to deal with it, it can be handled, but just make sure you got enough time to handle it. All right, under here, under 9, let me just mention this because I put this on new this time. This wasn't on there last year, and that is I have noticed a very obvious drop in collection activity with the IRS over the last year. Very obvious. I mean, way less activity. I asked an agent about the other day. She said that they're not paying for their travel anymore. Collection agents travel because they inspect properties, and sometimes they go down to the courthouse and inspect records. But they won't pay them for travel, so they're not traveling. They got a hiring freeze. They're not hiring anybody. And this lady told me they were at 1/3 of the staff they were at 4 or 5 years ago. So they have really cut back on what they're spending on collection, and in my opinion, looking at it from the revenue services side, it's crazy because they've got statistics that show that every dollar they spend on collection nets them $6 or $8. In other words, collection is productive. They get more money from collecting than if they don't collect. And I don't know how y'all feel about the IRS, but I pay my taxes, and I'd like for everybody else to pay theirs, you know.
If they're short on personnel and only have a third, does that mean my chances of being audited is 1/3?
Well, this is the collection side. I haven't been told that on the audit side. I deal more with the collection people than I do the audit. You know, I sometimes I even get, if somebody has a CPA that's their CPA, I get the CPA in on the audit because, you know, they're plowing through records, and, you know, that's not my deal. I mean, I'm here to help somebody with the legal issues, and usually the CPAs don't want to have anything to do with the collection side. But I would guess if they've cut the collection back to 1/3, they probably cut back the audit side some as well. Just be my guess. You know, budget cuts, that's all that's about. Okay, employment tax liability. The gentleman here was asking me earlier, if you have a business and have employees, then you are supposed to withhold from their payroll the taxes that are due to both the IRS and the State Revenue Department. And you deposit those into the bank, a bank account that remits them to the IRS, and then you file a periodic return that recites what you've remitted, and it's got to jive with, you know, the W-2s you sent out to your employees. If you don't remit the monies that you're supposed to remit, then you can have personal liability for that, even if your company is a corporation or an LLC where you wouldn't normally have personal liability. Most of y'all probably know this, but if you don't all know it, if you have a corporation and it has assets, and you respect the corporate entity and treat it right and don't abuse it, then if the company gets in trouble, you can bankrupt the company or walk away from it, and all the creditors of the company, the vendors that have done business, and your landlord, they can't sue you personally. They got to look to the corporate assets. Corporations and LLCs are limited liability entities. But the one big exception is if the liability is to the IRS because you were supposed to remit taxes on behalf of your employees and you didn't remit them, then you've got personal liability for it, okay? And not all of it, but most of it. The part of it that's called the trust fund portion. In your employment taxes, when you remit $1, about 20% of that is actually a tax that's on the employer. The other 80% or 75% roughly, something in that neighborhood, is pulled out of the employee's gross wages, so it's their money. And you're considered a trustee in effect. That money's called trust fund monies. So if the corporation doesn't remit those monies, and you're the person who was supposed to be doing it, or you're one of the persons that is supposed to be doing it, because they can go against multiple persons, then you can have personal liability for it. Usually the people that are going to be liable for that are senior officers, majority owners sometimes, maybe members of the board of directors, it depends, possibly the treasurer, possibly the bookkeeper. And the statute is written broadly enough where there's even been accounting firms who handle payroll for their clients held liable for these taxes. Okay, so at the very end of this section, They have 3 years to assess that liability, 3 years, and then 10 years to collect it. The statute for assessing liability is 3 years. Now there's 2 exceptions to that. One is if you omit 25% or more from your income, it's a 6-year statute, and if you can be shown to have committed civil fraud, then it's an open statute. Also, if you don't file a return, it's always an open statute. The IRS they could assess liability that's 30 years old if you didn't file a return 30 years ago. They don't normally do that, but they could.
Employer.
I'm sorry?
If they didn't pay on the behalf of the employer, if they
If
didn't got the proper tax.
if the employment taxes were not remitted, the IRS has 3 years to assess that personal liability against the officer who was supposed to have remitted it. There's 2 traps in the employment tax area, in my opinion. The first trap is the IRS usually doesn't catch this, and for the life of me, I've never known why, but they usually don't catch this for 8 or 10 quarters. So you're talking about 2 years or 2.5 years. Well, by the time you haven't, and you know, you miss that first month, and you go like, hey, this was easy. This only happens when your business is in trouble. Your business is in trouble, the landlord wants his rent, the utilities want their bills, your employees want their paychecks, but the IRS doesn't have their hand out. They're expecting you to affirmatively make these deposits and report. So you miss a quarter, and every time the person misses the first quarter, they go like, well, I'll catch it up next quarter. I'll catch it up, we'll pay a little interest and penalties. So they've decided to take an expensive loan from the Uncle Sam. And so Uncle Sam doesn't come get them that first quarter, and so they go, that was easy. And they go a second quarter, they go a third quarter, they go fourth, fifth, and finally the IRS catches them. And the reason that's a trap is because by the time you're 10 quarters behind, even if you got 4 employees or 8 or whatever, just a small outfit, you owe tens of thousands of dollars, maybe hundreds of thousands of dollars. It's a lot. It builds up quick. And so the first trap is the IRS is going to let you put a noose around your neck. They're going to let you, they're not doing it to be mean, they're just doing it because they don't have a mechanism in force or in place to know that you're not doing what you're supposed to do on a real-time basis. They usually learn it when the employee goes out and files his tax return and claims that he has or she has credits for the money you deposited. And the interesting thing is, if you don't deposit, you still get credit for it. I mean, if the employer doesn't remit the money, you still get credit on your Social Security for those taxes. So the second trap is it's not dischargeable in bankruptcy. Like I said, as I mentioned earlier, the liability can come through the corporate veil to you, but the second part is if you got this huge trust fund liability on you and you just say, you go down and see bankruptcy lawyer and say, look, I got a bankrupt on this. I heard Mike Wisner say you had to wait 3 years and then you could bankrupt. And he's going to say, well, that's true for income taxes, but it's not true for employment taxes. Not dischargeable in bankruptcy, period. Trust fund monies. The word trust is the key there. Good advice from me, your business gets in trouble, don't pay your utility bills, don't pay your landlord, hell, don't pay your employees, but pay your employment taxes. I mean, that's the only one you can have personal liability for. But unfortunately, everybody always does it exactly the opposite. Yes, ma'am.
If you pay your taxes appropriately and file appropriately, how long should you keep your returns? How many years?
You know, there's not a big reason to keep them much longer than 3 years because unless you've got a 25% omission from your income, they can't go back more than 3 years. You know, you might keep them a little longer than that. I mean, if they're not really in your way, keep them 6 years. I hate to say it, I've got every one I ever filed. They're down in a file in the basement somewhere.
What's the 6 years open statute? What does that mean when you?
Well, the 6 years is if there's a 25% omission from income. The open statute would be if you either committed fraud or you didn't file a return. Open means the statute never runs.
What is considered fraud? Examples of it.
Receiving income that you don't report, consciously don't report, or taking deductions that you're not entitled to. I mean, I tell you, there have been some tax preparers, I've dealt with 2 of them, where they got in trouble with the IRS and all of their clients got in trouble with the IRS because they were out. I had one down in Dothan. I used to live in Dothan a long time ago for a little while. And this was an accountant, and he was going around to people, anybody that had a house and some acreage. If you had a house and lived on 20 acres, he'd say, look, I can file this as a operating farm. And he's just making stuff up and getting paid on a percentage of the taxes he paid. Saved him, which is unethical. Anyway, he got, IRS decided he couldn't practice before them anymore, and I think he got like 7 or 8 $100 fines. It wasn't very much, considering what he had done, but all of his clients got audited. Yes, sir.
Sir, again, 2 questions. One of them, could you address the fact that they're sending out these letters, these 4 letters that you mentioned, and there's so many scams going on, people getting letters saying, send us your money, whatever, or we're going to file a lien against you. So if you could address the scams, and the second question, going back to hers about how long to keep your records. What if you had property that you had depreciated over even say 20 years, do you have to keep all 20 years worth of returns?
Well, let me address the second one first. You know, if you're in a business and you're depreciating property, yeah, you should always keep records of your
Well, I'm talking about like rental property or something.
Well, you got to keep up with your basis on rental property. Right. And so, you know, if you own a rental property for 20 years, I don't know that you have to keep your tax returns 20 years, but I certainly would keep up with my basis. Yeah. You know, if you've depreciated on a normal depreciation method and you can show when you bought it, you can just about make that argument with the IRS without having any records. You say, look, I bought it 20 years ago. I have it on a schedule for 39 years, you know, and you just do the math. But, you know, I caveat that 3-year thing by saying if you're in business, there's any kind of business, and I consider rental property, I mean, it's a passive business, but, you know, it might make sense to keep records longer, sure. I would agree with that. What was the first question again, sir?
The scam letters.
Okay, the scam letters. You know, if you have any reason to think a letter's not legit, the IRS always has a 800 phone number on there. And if you dial it and you get the recording, you may as well hang up because you know it's a good letter. That's what you're going to get, a recording. I mean, if you want to sit there 20 to 30 minutes and talk to somebody, you can do it. But if you get the standard IRS recording, you know the letter's valid. Now, I'll tell you what I've seen here lately is people are sending these letters, and I've seen several of these lately, and they make, as the gentleman indicated, they make them look like IRS letters, but and they just say you owe this money, and IRS is they don't say that they're not the IRS. They say IRS is going to take action, and they've actually made them physically look like them, and they kind of got the same logos. And all they're trying to do is get you to call them so that, at least I think this is what they're doing, and maybe they're asking them to send money. But when I've seen them, the ones I've seen, I think they're trying to solicit your business for them to help you with these IRS matters. They can sit in California or New York or Chicago and go online and get these tax records from the probate office all over the United States. All over the United States. Now, they can't get them from ours online, but most places you can get them online, and they just get them and they send these letters out, and some people respond to them. He's telling me 2 minutes, so let me just tell you, if you're having trouble with the IRS, they've either levied or filed a lien or they're seizing property, and there's not a lot of time. That's when you want to invoke this. You've got the right to do what's called a collection due process hearing. And as soon as you send that in, they're supposed to suspend their activity. And the purpose of a collection due process hearing is for you to say, I want to do an installment agreement or I want to do an offer in compromise. Usually this happens when the taxpayer has waited too long. They come into me, they say, I'm fixing to get levied. They maybe already have gotten levied. Their employer gets a levy. I said, look, I can stop it. Collection due process hearing request. We'll stop it temporarily to give you the opportunity to work something out with them. Okay, I guess, let me just mention this real quick. When the IRS gets through with you, usually the state of Alabama shows up. They have an agreement. They have an agreement where they exchange information. If the state has visited you first, which is less, is more rare, they usually come behind the IRS. But the same thing happens. If they visit you first, the IRS will show up, especially in the employment tax area. But they have an agreement to share information, and if you're talking to one, you're going to be talking to the other probably.
Is the Alabama state statute three years?
Yes, 3. Alabama statute's 3 years, except if the IRS has assessed you, when you get assessed, then no matter how much time's left on your state statute, the state gets at least 6 months. They got 6 months after the IRS. So if the IRS gets you late in the 3 years, the state's got another 6 months. Okay, I got to cut it. I'll talk to you after.
Thank you so much, Michael.